Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields pushing higher again, although they failed to make a new year-to-date high. We got just short of 3.10 in the 10-year yield. If you look over to its counterparts in the 2 and the 5-year buckets, they made new year-to-date highs, but they've been a much stronger bunch in yields pushing higher. But we failed. We didn't fail, but we just didn't make a new high. It looks like the trend is still going to push higher. We'll make another attempt tomorrow heading into the weekend, and if there aren't any trade or tariff talks that will throw a wrench into this, we may just see that. Otherwise, we'll see a modest pullback ahead of next week's FOMC meeting, and that will become the new focus. Market volatility was a little bit bid this morning, following in yesterday's footsteps, but was welcomed with open arms as sellers came in. That has been the trend. Any upticks in volatility, sell them, because the market will revert back to its mean, which right now is looking closer to between 290 and 295 yield. Now we're away from that, but I think that market makers are expecting a move back into that comfortable range once we get past next week's Fed meeting. And lastly, let's look at the positioning heading into this Fed meeting. The leverage fund community in the 10-year notes is max short. And I say max short, it's the most they've ever been short in the history going back to 2006. It's not a whole lot of data when you look at some of the other contracts, but it certainly gives you a pretty good picture as to where the market ideas, I believe, or where we're seeing the momentum moving. Last time we had yields this high, we had about half as many shorts on the board. So there is still, I don't know how much further this can move based on the positioning of the hedge fund community, given the fact that they're all already short and they're already maxed out. So I think right now we may have some difficulty breaking above that 312 high, or at least extending it maybe to 3.25 like some have said, with the idea that maybe we need to see a hiccup and a pullback, look for some of those shorts to get covered, and then reload. Maybe if some of the banks or if some of the real money customers come in and sell this thing down. So right now we look to be kind of top heavy here in treasuries with a modest pullback coming. I do expect that ahead of FOMC. I don't think we're going to go in guns blazing into the FOMC meeting with the idea that possibly we could see a reversal if the Fed is not as hawkish as the market looks to be pricing them. So right now, 10-year note yields on the high, probably another day of it, but look for a pullback ahead of FOMC. This is Todd Colvin coming to you from the floor of the CME Group.